The implosion of Theranos, a saga often reduced to dramatic headlines, represents far more than a simple corporate downfall. It offers a chilling Theranos documentary summary of how unchecked hubris and calculated deception can utterly obliterate nearly $1 billion in investor capital. This channel dives beyond the sensational, dissecting the raw financial data and boardroom mechanics that enabled a $9 billion valuation to evaporate into absolute zero. While much has been publicized about the superficial lies, the deeper untold fraud secrets lie within the financial engineering, the systematic misallocation of capital, and the calculated exploitation of information asymmetry that sustained the charade. Beyond the sensational headlines, the critical question remains: how did a company with no functional product attract and retain nearly $1 billion in capital, systematically bypassing the standard financial due diligence mechanisms that protect investors from such absolute zero-sum outcomes? We will forensically examine the exact financial pathways, the obscured balance sheet realities, and the investor psychology that allowed this phantom empire to materialize, thrive, and ultimately collapse, leaving a trail of economic wreckage. At its peak, Theranos commanded a private market valuation of $9 billion. Positioning itself as a revolutionary force in diagnostic medicine, promising to transform healthcare with a single drop of blood. This valuation, however, was fundamentally detached from any tangible revenue, functional product, or audited financial performance. The company's actual enterprise value, stripped of its speculative premium and revealed by subsequent liquidation, was precisely zero. Total liabilities, initially obscured by non-disclosure agreements and private funding rounds, ultimately ballooned into hundreds of millions, far exceeding any remaining asset base. Cash reserves, once plentiful from successive funding rounds, dwindled to negligible amounts as the burn rate accelerated without a corresponding revenue stream. Debt service became an irrelevant metric as the company had no real income to service any debt, ultimately relying on fresh equity injections to cover operational costs and legal defense. The structural mechanism of Theranos' failure was not merely bad leadership or toxic culture, but a catastrophic financial disconnect. The systematic misdirection of capital into a non-existent asset, generating zero return on invested capital. This entity's core business model was an asset-liability mismatch of unprecedented scale, promising groundbreaking technology while possessing only empty labs and unproven prototypes. Its cost of capital, primarily derived from private equity and high-net-worth individuals, was high, reflecting the speculative nature of early-stage biotech. Yet it never generated even a theoretical positive, ROIC. Interest coverage ratios were non-existent because no legitimate interest-bearing debt could be justified against an asset base that lacked functionality. The financial statements, if properly disclosed and audited, would have revealed a continuous and accelerating cash burn directly into unvalidated research and development, essentially a black hole for capital without any verifiable commercial output. This represented a fundamental breach of fiduciary responsibility, transforming investor funds into pure operational expenses for a product that did not perform as advertised. The boardroom's capital misallocation began almost immediately upon its initial funding rounds, accelerating after key investments. Instead of rigorously deploying capital into verifiable scientific progress and independent clinical trials, substantial portions were directed towards lavish offices, inflated executive salaries, and most critically, an aggressive legal strategy designed to suppress dissent and conceal scientific failures. In 2014, with significant capital injections from investors like Rupert Murdoch and Walgreens, Theranos initiated a massive capital expenditure program, not on proven R&D facilities, but on acquiring properties and constructing a luxurious headquarters. Millions were spent on marketing and PR campaigns to cultivate an image of disruptive innovation, rather than investing in the actual scientific validation necessary to build a viable product. The company's legal budget escalated dramatically, estimated at tens of millions annually, primarily dedicated to silencing whistleblowers and delaying regulatory oversight, a clear misallocation that diverted funds from critical product development. These strategic decisions, made under the direct authority of Holmes and her inner circle, directly created the structural vulnerability, a vast financial outlay with no corresponding increase in functional, revenue-generating assets. The active endgame for Theranos was not a traditional Chapter 11 restructuring. It was a complete dissolution and a criminal indictment, representing the terminal phase of a fraudulent enterprise. The business model was definitively an artificial byproduct of unchecked private equity and venture capital chasing speculative innovation, rather than a viable core destroyed by an unsustainable capital structure. There was no sustainable core. The foundational premise was fabricated, built upon lies regarding technology, operational capability, and clinical efficacy. Any capital structure, no matter how robust or cheap, would have ultimately collapsed under the weight of a product that simply did not exist. The company's eventual asset sales, once the fraud became undeniable, generated only a fraction of its total liabilities, confirming the true negative enterprise value. The total investor loss, approaching $900 million, stands as a stark testament to the consequences of insufficient financial due diligence and the allure of disruption overriding basic economic principles. The ultimate resolution of our open-loop how Theranos bypassed standard financial due diligence lies in a confluence of factors. The powerful narrative spun by Elizabeth Holmes, the prestige of her board members who often lacked direct financial oversight experience, and the general venture capital appetite for high-risk, high-reward biotech plays that promised exponential returns. Many investors, swept up in the vision, neglected fundamental quantitative analysis, such as validating unit economics, scrutinizing cash flow statements, or demanding independent audits. This collective blind spot allowed billions to flow into an entity built on a foundation of scientific and financial fiction, ultimately leading to its complete and irreversible economic obliteration. For a deeper dive into the catastrophic intersection of executive hubris and market speculation, make sure you watch our forensic analysis of FTX's astonishing $32 billion valuation implosion, mapping how algorithmic leverage created a liquidity mirage